As I've mentioned in other presentations, there's really only three ways to pay for long-term care expenses and nursing home costs. The first general way is with the proceeds of insurance policies. Now these might be long-term care policies, whether they're qualified policies or non-tax qualified policies. It could be through short-term care policies, and it might even be through hybrid life insurance and long-term care policy combinations. But for people who do not have insurance policies to cover their long-term care costs, the two remaining payment ways are essentially going to be privately paying from your own income and assets, and for people who do not have sufficient income or assets to pay for their care, it's going to essentially leave the option of applying for government aid. And the most relevant government program, as we said, is going to be Medicaid. So the question then becomes, how does one specifically qualify for Medicaid? How does Medicaid determine eligibility? Now there are two overarching considerations. The first is financial, and the second is medical. Now I've already said that you have to bear in mind that this is a complex conversation, in part because Medicaid eligibility requirements are going to vary slightly from state to state. And because of this, you're going to want to consult with an expert who's knowledgeable about your state. Most of what we're going to say is going to have to do with the financial eligibility requirements because they are so complicated, but let me say a bit about the medical requirements just right off the bat. Generally speaking, Alzheimer's level cognitive impairments are going to be enough to qualify you so long as they are sufficiently advanced in their severity. Now in some literature you will encounter phrases like nursing home level care, but the specifics of this are going to vary from state to state, so once again you need to seek advice. Often this nursing home level of care is going to be calibrated to the type of supervision that a person requires if they have cognitive impairments, or it may be calibrated to the various activities of daily living that they are lacking, and I go into that in other videos. But what I'm mainly going to be concerned with is going to be the financial eligibility, and that's essentially determined by two calculations or tests, an asset test and an income test. The question of assets is going to preoccupy us in this video, and in a subsequent video I'll talk about the income test. They're both intricate conversations, and so it would probably be best to break the conversation up into two pieces. Now the basic reason that these tests exist at all harkens back to the stated purpose of Medicaid as we kind of sketched previously. Medicaid provides financial assistance for medical expenses for people who are impoverished. And so the question is, who qualifies as impoverished? And the answer to that question is determined by these two tests. Basically, the idea is if a person's assets fall below a certain level and their income falls below a certain level, then they count as impoverished in Medicaid sense. Now let's consider assets first. Just to lay it out there, essentially a person has to have $2,000 or less in order to qualify for Medicaid from an asset standpoint. Now assets themselves are classified in two categories. The first are countable assets or non-exempt, and the second are exempt assets, or those that are not countable. The precise scope of the exemptions and countability will vary from state to state, so once again, you need to consult an expert in your area. But usually an exempt asset is going to be something like the Medicaid recipient's primary residence, a car, and so on. You have to bear in mind that Medicaid can cover people of various ages. It's not just for people who have Alzheimer's disease, dementia, and other cognitive impairments. So while the focus of this channel is on people who do have Alzheimer's disease or some cognitive impairment, Medicaid is more broadly applicable than that. So for example, it might happen that a 30-year-old Medicaid recipient has a primary residence, has a car, and can get around with no problem. Now, while it is unlikely, and not to say ill-advised, that a person with advanced Alzheimer's will be living alone or have a car, those restrictions are not imposed by Medicaid. Those are simply results of the advancement of their disease. But the real question occurs when an Alzheimer's afflicted individual has a spouse who has no affliction. What happens with the assets in that case? And the answer is that the non-afflicted spouse, sometimes referred to as the non-institutional spouse or the community spouse, will also have some assets that are going to be exempt. For the non-institutional spouse, those assets will usually include the primary residence, a vehicle, and so on. Now you need to know that Medicaid will sometimes claim reimbursement for the sale of a home after the Medicaid recipient has died, and you should be aware that Medicaid is supposed to seek recovery for money that it spends on a recipient's care. Because of its strict monetary eligibility requirements, a Medicaid recipient is unlikely to have had any property apart from a home. For this reason, Medicaid often becomes a lien holder against the primary residence, and it may seek to collect money that was generated from the sale of the home. In a few cases, a home may be required to be sold in order to settle with Medicaid. However, there are many exceptions to this. In some cases where the non-institutional spouse or a minor child or some other dependent is still living in the home, Medicaid may either be unable or unwilling to seek recovery. This is complicated territory, and once again, you need to consult with a licensed professional who is familiar with these kinds of cases. You should also be aware that there are sometimes limits imposed in terms of how much equity can be inside the house. Now, whether this is applicable or not often depends on whether it is the Medicaid recipient, him or herself, who is in the home, or whether it is the non-institutional spouse. Where equity limits do apply, they tend to vary year to year. In 2020, the amount of allowable equity in a home is about $600,000, technically about $595,000. In some states, it can go all the way up to closer to $900,000 or about $893,000. In 2020. Intuitively, the reason for the equity limit is so that a person sitting on a $2 million mansion could not qualify for Medicaid, when the sale of the home would be enough to discharge both their medical expenses and more modest housing costs. In cases where the spouse is dwelling in the home, equity limits may or may not apply. Consult your Medicaid planner. For the most part, assets beyond personal effects like furniture and clothing will be counted, and this will include cash and banking assets. This means that non-exempt assets will include liquid and semi-liquid and cash assets. For example, it will include unsettled annuities, bank accounts like checking accounts and savings accounts, as well as certificates of deposit or CDs and money markets. It will include brokerage account and other investment accounts. It will include cash value life insurance and retirement accounts, including 401ks and other employer-sponsored defined contribution plans like 403bs, 457bs, and the like. It will also include individual retirement accounts like the traditional and Roth IRA. It will also include property beyond the primary residence and the main vehicle. So for example, if you have a vacation home, that would be a countable asset. If you have a boat or an RV, that is a recreational vehicle, these would be countable assets as well. And as I said before, a person having more than $2,000 in countable assets will be considered ineligible for Medicaid. Although some states, like New York, have set other asset limits. So how does it work if assets are shared in common with a spouse? Well, there are two sorts of state, a 50% state and a 100% state. Each of these types of states handles assets a little bit differently, and we'll run through each of these in turn. Now, my unofficial count was that approximately 35 states are 50% states, so I'll start with that. Now, the details vary, but usually it happens something like this. All of the countable assets are totaled together. So consider a married couple. Let's call them John and Jane. Countable assets will include assets that are owned entirely by John, assets owned entirely by Jane, as well as assets that they have in common. So these are all totaled up, and then the result is divided by 2. In general, the non-afflicted spouse is going to be able to keep half, 50%, of the total within certain limits. And there is a lower limit, and there is an upper limit as well. Now, the minimum and maximum amounts are likely to vary year to year, just like the IRS varies the amount of deductions or varies the amount of retirement contributions that you can make from year to year. In 2020, the lower limit is $25,728, and the upper limit is $128,640. Depending on when you watch this video, those limits may have changed. Now, in theory, a person could ask Medicaid to keep an amount outside of those limits, and this would be established through a Medicaid fair hearing, but in practice, those are the limits. Now, this is complicated stuff, so an example or two might be helpful. Let me actually run through 3 different scenarios just for illustration purposes. Let's take a middle-of-the-road example to begin. Let's firstly suppose that John's assets and Jane's assets together total $100,000. In a 50% state, we would take that total and divide it by 2, which would be, of course, $50,000. Since $50,000 falls somewhere between the lower limit of $25,000 and some change and the upper limit of $128,000 and some change, in this case, the non-institutional spouse would get to keep $50,000. On the other hand, the institutional spouse since that person can only have $2,000, that person would need to spend $48,000 down in order to qualify for Medicaid from an asset standpoint. Let's consider a case now where the assets are a little bit more substantial. Let's suppose that Jane and John both together have $300,000 in assets. Once again, applying the 50% calculation, we would take $300,000 and divide it by 2. The resultant amount is $150,000. Now we notice that $150,000 exceeds the 2020 limit of $128,640. This means that the non-institutionalized spouse will only be able to keep up to the limit, or $128,640. Because the institutionalized spouse can only keep $2,000, that means that the remaining money has to be spent down. In this case, that means $169,360 will need to be spent down. For our third example, let's consider a case where the assets are far less significant. Suppose that Jane and John have a total of $30,000 to their names. When we divide that number by 2, we get $15,000. And we'll notice that $15,000 is less than the minimal amount of $25,728. That means in a 50% state, the non-institutional spouse will get to keep $25,728, despite the fact that that amount exceeds 50% of the asset total. On the other hand, since the institutional spouse can keep $2,000, that means that the remaining $2,272 would have to be spent down in our third example. Notice that there is an asset spend down that occurs when one's countable assets exceeds allowable amounts. Now, as I said, not all states operate on a 50% basis. Some are what are called 100% states. In some cases, the practical difference is very slight. So for example, suppose that Jane and John did have $300,000 of total assets. In a 100% state, the non-institutional spouse would again be able to keep up to the maximum of $128,640 in 2020. That was the same amount that they got to keep on the 50% state rule. On the other hand, if the assets are less significant, the 100% state approach can make a bigger difference. So suppose that Jane and John had a total of $100,000 of assets. In a 100% state, the non-institutional spouse would keep all $100,000. Similarly, if the assets were a total of $30,000, in a 100% state, the non-institutional spouse would keep all $30,000. Essentially, in a 100% state, the non-institutional spouse gets to keep all the assets up to the limit, which is $128,640 in the year 2020. Now here we run into a potential pitfall. Upon learning about Medicaid's austere requirements and upon surveying your own financial situation, couples might be tempted to start giving away assets, whether it be to relatives, to friends, or to charities. This would be a bad idea and a very dangerous course of action to embark on. You need to be exceptionally careful here. Medicaid's asset transfer rules are every bit as stringent as its other requirements. Running afoul of Medicaid's asset transfer regulations can result in the imposition of what is termed a penalty period. This is a period of time when the applicant would be ineligible for Medicaid because of procedural violations. And you should be aware that the penalty period only begins once the applicant is otherwise qualified for Medicaid, and often once the applicant is already in a long-term care environment and receiving care actively. That means that the Medicaid applicant would be in need of the assistance, but would be unable to get it because they were being penalized. In other words, they would be up a creek without a paddle. In general, at least for long-term care scenarios, Medicaid can and will review an applicant's financial history and financial reports going back a full 60 months or 5 years. This scrutinized interval is referred to as the Medicaid look-back period. And Medicaid is looking for transfers that are inadmissible from the standpoint of its regulations. Illicit transfers might include things that you might call illicit gifting, and also sales that do not pass muster. Illicit gifting would be giving gifts apart from what would be reasonable to celebrate occasions like birthdays and anniversaries, or beyond what would be expected and reasonable in terms of holidays that your family normally observes. So for example, giving little Johnny $50 on his birthday or buying him a video game might not raise any red flags, although if you are in the process of Medicaid planning, you need to consult with an attorney about every move that you make. On the other hand, giving the family cabin to your brother and calling it an Arbor Day gift is probably going to land you in hot water. So don't make that kind of a mistake. But seriously, even inadvertent violations of asset transfer requirements can be penalized severely. Your best bet is to consult with an attorney who is knowledgeable about Medicaid transfers. First of all, lawyers are liable for the advice that they give to you. And secondly, it's against federal law to advise anybody to make asset transfers in such a way as to try and hide assets or to cheat Medicaid. And if a person's advice results in the imposition of a penalty period, then the person giving the advice can be criminally liable. And once again, this video is not intended to be construed as advice of any kind. It is for general informational or entertainment purposes only. You need to consult with experts in your area, more in this case probably than in any other. Because it's serious business and you can get in trouble even if you aren't gifting assets, but if you're selling them incorrectly. This is especially the case if the sale price is below the fair market value of whatever the item is. So for example, if your car's blue book value is $10,000, but you sell it to your granddaughter for 25 bucks, this is going to do more than raise eyebrows. It could get you into a lot of trouble. But that doesn't mean that no asset transfers or sales are permissible. And this is an important point because it's to be expected that a person who's transitioning into a new era of their life, going into a long-term care facility, a nursing home, they're going to be downsizing and they're going to be getting rid of some of their property almost for sure. The point is that you'd be far better getting competent advice when you make these changes than you would be otherwise. So permissible asset transfers might include retitling the home in the name of a spouse, in the name of a caretaking child, or selling items at their fair market value, provided of course that the proceeds from the sales are duly noted, tracked, and then reported as part of the countable asset calculation. But once again, asset transfer rules are state specific, and any Medicaid planning and preparation should be done only under the express advice of an attorney. Now let me say a few words about life insurance. The real difficulty with life insurance is going to be the cash value. So this is going to mainly apply to policies that are built on a whole life or a universal life chassis. Term policies that have no cash value generally can be retained at any face amount. The face amount would be the amount that you would expect to pay out in the event of the death of the insured. On the other hand, permanent policies that have cash value are going to be limited to a $1,500 face value. That means they can only pay out $1,500 in the event of the death of the insured. So if the face value is $1,500, the cash value is expected to be south of that. Any other policy most likely will need to be surrendered or cashed out. Cash value policies also need to be tracked carefully even if they are kept. So if a policy falls under that $1,500 threshold, it still is going to need to be carefully tracked because number one, the cash value is still part of the countable assets, and number two, if the policy's cash value increases or changes year to year, or if the face value goes up, the policy may qualify this year and may not qualify next year. Now, the income requirements are every bit as complex as the asset requirements, and so I'm going to take a pause here and I will get into the income test requirements in a follow-up. If you found something of use in this video, I ask that you like the video. If you found this content useful and you would like to see the follow-up, I invite you to subscribe to the channel. Click the notification bell if you would like to be alerted to that content when it becomes available. And if you know of somebody who might find this content useful, I ask that you share it with them.